Hello, this is Max, and you're listening to my bull thesis on Thryv. But firstly, I'd like to state that I'm not a financial advisor, and this video is not financial advice. It's strictly for entertainment purposes only, as I'm presenting this information for fun. So the company is called Thryv, and the ticker symbol is THRY. So what is Thryv? Thryv has two main sources of revenue. It's actually a holdings company with two different companies that are both called Thryv. And one is a software as a service company, and the other is a Yellow Pages digital marketing company. The Yellow Pages digital marketing company brings in a lot of their revenue. The Yellow Pages company is declining in revenue while the software as a service company is increasing in revenue. Thryv's main potential comes from their software as a service side, and the idea of their company is that it's a tool to empower medium-sized businesses, companies less than 50 employees but greater than one or two. And they have all these different tools a part of their software. It's basically just a software tool that small businesses can plug their information into, and it'll market for them. It'll help them generate reviews. It just does a lot of things, and it's honestly a pretty neat tool. But in short, the Yellow Page sector, the company is declining while the software as a service company is expanding and growing. Here's just a little snapshot of their 2020 quarterly financial highlights for the software as a service sector. And as you can see, software as a service sector is increasing by the quarter. Quarter two of 2020, it did like 31.5 million of revenue, and by the last quarter, it was doing 35 million. I just wanted to show you guys that the revenue was trending upwards for the software as a service sector, and there's definitely more potential and room for growth. So here are some investor numbers for Thryv. To start, I wanted to state their incredible PE ratio, which is at 6.27, which is insane, especially for a software as a service company. Their price to sales ratio is 0.83. Yes, it's less than 1, which is also insane. Their software as a service growth, or the general software as a service growth metric, is 12% for the next 5 years. Their revenue is 1.2 billion. Their earnings is 150 million, excuse me. And their earnings per share is 3.31. The bond yields currently is 3.02. The EBITDA margin is 33%, which indicates a very safe company. And their fair valuation based on the Ben Graham model is $91. Now remember that number, $91? Yep, they're only at $27.59 right now, which means that they are more than 3 times under what their fair value price is on the conservative Ben Graham valuation metric. So a similar company that I want to compare them to is HubSpot. They both target that medium-sized business and provide a software as a service tool. The PE ratio of HubSpot is 362 compared to Thryv's PE ratio of 6.5. The price to sales ratio of HubSpot is 28.75, while Thryv's is 0.82. The market cap of HubSpot is 23 billion, while Thryv's is 900 million, basically valuing HubSpot at 29 times greater than Thryv. And then Thryv's total revenue of 2020, I've already stated this, was 1.2 billion, but their software as a service revenue for 2020 was 129 million. So if you were to value Thryv at the same valuation of HubSpot, Thryv should be at $56, which is approximately double the current price. And I just wanted to provide this information to show that software as a service companies can look extremely overvalued, although the market deems them at a fair price because there's so much potential. And this is either a tale of HubSpot being overvalued or Thryv being undervalued. And most likely it's a little bit of both, but either way, it's very clear that Thryv has room for growth. And so here's my general analysis. So Thryv is a heavily undervalued company, and it's most likely because the market sees it as a dying Yellow Pages digital marketing company rather than an expanding software as a service company. And also it's because it IPO'd recently, and I really just don't think the market sees it as what it is. And I truly believe anything under $30 is a strong buy. It's currently at 27.8. And in regards to risk, the software as a service division is still developing, therefore giving it moderate risk. But because of the proven numbers of 130 million in revenue already, there's clear numbers to back it up, and it's in an industry where a high PS ratio is acceptable. So that makes it somewhat better because, their main source of revenue is dying, right? The yellow pages industry. But also, the stock is in a minor bubble in the last 6 months. It's up almost 3 times, but it's still so undervalued. I don't, it's it's bubbling, but it's also still so undervalued. It's like, is that justified? And it might be a bumpy ride because it's a tech company and it's a low market cap company. It's less than $1 billion. But I believe the market should eventually discover the numbers on this company and see the great PE ratio and, slowly inch the stock closer to 90 in the next coming year or two. Yeah, so that's my take on Thryv. Take everything I said with a grain of salt. I don't know anything. I'm not a financial advisor, but based on some simple quantitative fundamental analysis, I believe that Thryv is a strong company and clearly has some strong numbers when compared to its peers. Thank you very much.